Why do housing prices feel like they're on a different planet from your paycheck? In many cities, prices have doubled or tripled in a generation, while typical incomes have barely moved. In this video, we're going to uncover the hidden economics of housing prices, not just supply and demand, but debt, interest rates, zoning rules, investors, and even income inequality. By the end, you'll see why housing behaves less like a basic necessity and more like a financial asset. For most of history, housing was treated mainly as shelter, a long-lasting good you lived in, not a speculative investment. Today, in many economies, housing is the largest asset people own and a key part of the financial system. Researchers have shown that house prices are closely tied to both household debt and broader economic conditions, especially inflation and credit growth. In one study, a model using just industrial energy use and household debt could explain about 90% of the variation in U.S. house prices over time, suggesting that access to credit and the productive economy heavily shape what homes cost. So instead of thinking houses are expensive because we're building too few, it's often more accurate to say houses are expensive because we've turned them into leverageable financial assets in a system with lots of cheap credit. Let's start with the textbook story. Supply and demand. When more people want housing in a given area than there are homes available, buyers bid against each other, pushing prices up. When supply rises faster than demand, prices can cool or even fall. On the demand side, key drivers include population growth and household formation. More people and more households mean more demand for units. Income levels and job growth. Strong local economies attract people and support higher prices. Preferences for certain neighborhoods, school quality, walkability, transit access, and amenities all raise what buyers are willing to pay. On the supply side, builders face constraints, land availability, especially in coastal or land-constrained metros, construction costs, including materials and labor, local regulations and permitting, which can slow or limit new building. Location amplifies all of this. A small change in demand can cause a huge price jump in a high-demand, supply-constrained city, while the same change might barely move prices in a place with abundant land and easier construction. Now, here's where things get hidden. Housing prices are extremely sensitive to interest rates and access to credit. When central banks cut rates, mortgage rates usually fall, making monthly payments cheaper for the same loan amount. That boosts buyers' purchasing power. They can suddenly afford a more expensive home with the same income, which pushes prices up when supply is tight. The opposite is also true. When interest rates rise, monthly payments jump. Buyers qualify for smaller loans and demand cools. Recent market commentary notes that higher rates in the mid-2020s raised payments and reduced the pool of qualified buyers, slowing transactions even though prices remained elevated in many areas. Cross-country research finds that inflation and variables related to mortgage finance, like bank credit and short-term interest rates, are among the most important drivers of real house price dynamics over multi-year horizons. In other words, how easy it is to borrow money and at what cost does as much to shape housing prices as the number of physical homes. There's also the lock-in effect. Many existing homeowners locked in low fixed-rate mortgages when rates were near historic lows. When rates rise, they don't want to trade a cheap mortgage for a more expensive one, so they stay put, shrinking the supply of homes for sale even if there are buyers willing to pay. That tight resale inventory can keep prices high, even in a higher rate world. Beyond pure market forces, government rules quietly shape what gets built, where, and at what price. Land use regulations like minimum lot sizes, height limits, parking requirements, and bans on multifamily housing in large areas can severely restrict how many homes can be built in desirable neighborhoods. A report referencing a Cato Institute study found that rising land use regulations contributed to home price increases in the vast majority of U.S. states, with zoning rules linked to higher prices in at least 36 states. Regulation also adds direct costs. The National Association of Home Builders estimates that roughly a quarter of the cost of a new single-family home and nearly a third of the cost of a new multifamily development can be attributed to various regulatory burdens. These include fees, compliance with codes, delays in approvals, and infrastructure requirements. When you combine these regulatory costs with high land and material prices, developers naturally focus on building higher-end housing where profit margins are bigger. That can mean fewer truly affordable units get built, keeping lower-price segments of the market extremely tight. Another hidden driver is who is doing the buying. It's not just about how many people want homes, but which income groups are active in the market. New research looking back to the mid-1970s finds that for many years, house prices roughly tracked median incomes, but after around 2000, home prices grew much faster than the typical household's earnings. However, when researchers compared house prices to average incomes, which are pulled up by high earners, they found that average income and house prices grew almost 1-for-1 from 1975 to 2024. That suggests that rising prices in many metro areas are being driven largely by higher income households, not just by a simple lack of supply. In this view, the affordability crisis is less about not building enough units in the abstract, and more about how economic growth has been concentrated at the top of the income distribution. These researchers argue that to understand why some cities become so expensive, you have to look at changes in local labor markets, which jobs are growing, what those jobs pay, and how growth is distributed across income levels. When more high-earning households compete for housing in job-rich cities, their budgets effectively set the price level for everyone. Housing markets don't move just because people want homes. They move because people can borrow against future income. As mortgage systems became more developed and credit standards were loosened in many countries, households were able to take on more debt relative to income. That increased borrowing capacity allowed buyers to bid up the price of a relatively fixed stock of land in attractive areas. One quantitative analysis modeled U.S. house prices using industrial energy use and household debt levels and found that these variables explained the majority of price variation over time. The takeaway isn't that construction or population don't matter, but that the financial side, how much debt households can and do take on, plays a central role in long-run price trends. When prices rise, existing homeowners see their equity increase and can refinance or take out home equity loans, adding more fuel to spending and sometimes more demand for property. That cycle can continue until something breaks. Rates rise, lending standards tighten, or incomes fail to keep up with debt obligations. Rising housing prices come with hidden ongoing costs that reshape household budgets and local economies. First, property taxes often rise along with assessed values. Analysts estimate that U.S. property taxes on single-family homes increased significantly between 2019 and 2024, and those increases are slow to reverse, even if prices later soften. Second, the cost of owning a home goes far beyond the mortgage. Insurance, maintenance, utilities, and association fees all tend to be higher in expensive markets. One study estimated that the hidden costs of homeownership, things like taxes, insurance, maintenance, and utilities, added up to around $21,000 per year on average in 2025. These costs reduce disposable income for other spending and can widen gaps between owners and renters. Owners with rising equity and tax advantages accumulate more wealth over time, while renters face rising rents driven by the same underlying price pressures. You often hear the slogan, "Just build more housing." Increasing supply is important, but the economics we've discussed show it's not a silver bullet. First, in many markets, builders already struggle to keep up because of land constraints, labor shortages, and regulatory costs. Second, even when supply grows, if high-income households keep capturing most of the economic gains, they can still bid up prices in the most desirable locations. Recent research suggests that differences in housing supply constraints alone cannot fully explain why some metro areas have become vastly more expensive than others. Instead, the combination of income growth at the top, local job markets, and financial conditions appears to do much of the explaining. So policies that focus only on zoning reform may help, but they might not fix affordability if they don't also address income distribution, labor market access, and the design of housing finance. If you're a renter or prospective buyer, understanding these forces can help you interpret headlines and make better decisions. When interest rates move, don't just ask, are prices up or down? Ask how rate changes affect your monthly payment and whether local supply is tight or expanding. Pay attention to local job and income trends. Markets with strong employment and high earning arrivals can see sustained price pressure, even if national conditions soften. Watch for policy changes around zoning, permitting, or subsidies. These can shift the balance between luxury development and more attainable housing. And remember, housing is both a place to live and a financial asset embedded in a broader system of credit, regulation, and inequality. Understanding that system is the first step to navigating it. If you found this breakdown helpful, let me know in the comments. What's happening with housing prices where you live, and which of these factors seems most important on the ground? Don't forget to like, subscribe, and share this video with someone who thinks it's just supply and demand. There's a lot more going on behind the price tag of a place to call home.